Good evening and welcome to the Zero Hedge Oil and Gas Debate. I'm Erik Townshend, your host. Many of you know me as the host of Macro Voices, the free weekly podcast that targets professional finance, sophisticated and family office type of investors. We've got a fantastic panel lined up for you this evening. Arjun Murti is a partner at Veriton with over 30 years on Wall Street, a former partner and co-director of America's Equity Research at Goldman Sachs, and current director at ConocoPhillips. Murti remains the front line of energy and macro policy. Arjun, thanks for joining us.
Thank you, Erik. Pleasure to be here.
Next, we have Paul Sankey, founder of Sankey Research, a former lead U.S. oil and refining analyst at Deutsche Bank. Paul has earned multiple institutional investor rankings and spent his career dissecting global oil equities, refining cycles, and capital markets dynamics. Paul, thanks for joining us this evening.
Pleasure to be here.
And finally, Mike McGlone, senior commodity strategist at Bloomberg Intelligence. With more than 25 years in futures and commodity markets, Mike drives commodity market strategy at Bloomberg and offers deep insight into supply, demand, and macro commodity linkages. Mike, thanks for joining us.
Thanks for having me. I love that 25 years. That was from 10 years ago, so I'm pushing 4 decades now.
Okay, well, I'm working from what Zero Hedge sent me. Good. Let's dive right into this, guys. We're going to start with Arjun, and let's just start with, we'll do oil first. We'll come back to natural gas later in the program. Let's just start with the focus on oil. Arjun, is it time to be bullish or bearish here, and why? What's the high-level overview of the market?
I use the phrase that I think we're in the bottoming phase. So we've had 2.5 years of downturn from that $120 a barrel plus or minus Russia-Ukraine peak, which if I rewind for 1 second, negative oil at the worst point of COVID, we had COVID recovery, and then turbocharged by Russia-Ukraine. And there were a lot of calls at that point in time about people talking about a new oil super cycle. That's something we spent time on, both Paul and I did, early in our career. Our view was it is too early to call for new oil super cycle. I will acknowledge at Veriton and in my current roles, we don't officially publish forecasts, but I've been using the phrase super volatility, not super cycle. And the basic implication was we were sort of at the high end of the range at 120. We're now down $60 a barrel. And we can certainly debate whether there's another 5, 10, maybe even more of near-term downside. But we think we are plus or minus through the worst of it. I've been a big proponent that there's no such thing as peak oil demand, that no one can know what decade, let alone year, oil demand is going to peak. And we're starting to see those calls of peak demand getting pushed to the right. My phrasing is the lucky 1 billion of us enjoy full, rich lifestyles. The other 7 billion people are in various stages of improving their own. And there's kind of no debate over 4 billion of those 7 billion people in Asia. And for the first time in my 33-year career, the 1.4 billion people of Africa are starting to bubble up on oil demand numbers. I actually have to start to learn some of the names of these countries, all at a time where the best days of shale, I think, are behind us. It's not that it can't still grow. It's not that we couldn't have a high enough price that would stimulate it, but that it's become more price sensitive. And at least on my numbers, OPEC has kind of brought on most of their spare capacity. They may be a little bit left. And so it's going to be that combination of generally healthy oil demand, a much slower and mature shale business, OPEC kind of having run through its spare capacity, that is going to motivate the need for people to go out and start finding oil again after they were told for the previous 3-4 years, it's all over for oil, climate change, climate crisis, peak oil demand. I think all those narratives are going to get turned upside down. There's no question that it surprised most people, including myself, when OPEC said no mas to our production cuts. And so they brought on a bunch more oil. So I respect the fact that if we're talking October 2025 right now, and for the next couple quarters, there may be some modest oversupply, but I push back hard on that IEA oil glut view of 3-4 million barrels a day of oversupply. That would be worse than when we had COVID, when the world economy shut down. So could there be some oversupply? For sure. And that's why I use the phrase bottoming phase as opposed to we are definitively at the bottom. I'm not an oil trader, Erik. I'm an equity analyst, as historically has been Paul. And so it is a little bit more focused on what does the sector look like? And I think we're plus or minus in the last stages of what's been a 2.5-year bear market.
So in a bottoming phase. Thanks, Arjun. Let's move on to Paul Sankey. What's the high-level view?
I think when we argue that that there's a lot of sort of arguing about deck chairs and details in the oil market in terms of OPEC quotas and everything else, but when you boil it down, it's got to be kept very simple, obviously, and the first principle is always going to be demand, and that's a really strong starting point because we're at all-time high global oil demand here, about 108 million barrels a day, a level I don't think Arjun and I would possibly have imagined was possible, 20 years ago in terms of where we would be by 2025. There was the thought that you would have massive penetration of electric vehicles, as a simple example, continued declines in European demand, and so forth. So the fact that we're at this 108 million barrel a day level, with Arjun telling you that 1 billion people in the world are using 15 to 20 barrels a year per head of oil, and the rest of the world is more or less around 5 barrels per head per year. That becomes an incredibly bullish starting point. Now, having said that, we've also had a stunning performance from oil supply. So if you then said, we would have excess capacity at 108 million barrels a day, it's been a privilege to actually follow how this journey has unfolded. The other aspect of me, the way I started, was to talk about you've got to keep it simple. There's a lot of arguing about OPEC quotas or whatever else that you read people in furious arguments about, which are really details at the margin. What we argue is that you have to look at the global oil market in terms of that 108 million barrel a day level. So, for example, OPEC quotas are about black oil. They don't include NGLs, which would be natural gas liquids, which is a huge part of the market. And so the OPEC argument is about 30 million barrels a day, approximately, of a 108 million barrel a day market. So what we do is we look at the total market of 108 million barrels a day, and then we derive not a call on OPEC, but a call on US supply, because that's the most important marginal supplier of short-term oil that offsets the demand strength that we're seeing, generally speaking, this year. As of late last year, let's say September is typically the time when you start to think about getting bearish oil because of the seasonal pattern in oil. Basically, the oil market seasonally peaks in summer, Q2, Q3. This is a neutral season, Q4, and then you get the weakest season in Q1. As we were looking at the market in late 2024, what we were looking at seemed to be the need for US supply to come down by 2 million barrels a day to balance the market. So we were already looking at very bearish balances as we came into 2025, and it just hasn't been that bearish. We've been in a steady downward trend. We thought that we would have a very weak-ish 2025 and a super weak 2026. And as it is, 2025 has come in better than we would have anticipated. And that 2 million barrels a day of oversupply that we were looking at the margin for 2026 has now come down to a 1 million barrel a day oversupply. And that's been as a function of that demand number that we're talking about. So if you want to keep it very simple, global demand is very strong, and therefore you should be pretty bullish. It's very difficult with these numbers because oil is set at a 2 million barrel a day margin on a 108 million barrel a day market. And if we get a cold winter, you could get 2 million barrels a day of extra global demand just on cold winter alone. If we get a warm one, obviously the opposite. So these short-term forecasts are just extremely difficult to make just on a fundamental basis. And then we have certain characters such as Donald Trump, where, for example, you started out the Trump 2 administration thinking that the US was going into isolationism, and really wanting to back off from being the world's policeman. And here we are just 8 months, 9 months in, 10 months in, and we've never seen a US president be more involved in more countries in the world, more directly with more relation to oil than ever. And so that geopolitical picture becomes very, very difficult as well. Bottom line, as I said, this is a neutral season. We are looking for a low in February of next year. I'm staying bearish, actually, into that low. And then from an equity point of view, we're actually relatively bullish because, as Arjun has made the same point, the equities have more than discounted all of these risks. And the interesting aspect of this is what Arjun's referring to, is when we bottom for us in February of next year, and then we start potentially a very, very bullish long-term cycle of continued strength and demand and ongoing issues with US supply, which we think will go into decline. So near term, the old classic, near term bearish into February of 26, then very bullish.
Okay, tactically bearish into February and then bullish. Let's hear from Bloomberg's Mike McGlone. What's the big picture?
Well, I appreciate you letting me go last because I was able to take notes and I can address a few things. First of all, my Canadian colleagues, they asked me to go on Bloomberg TV all the time. It's a thing I love about this. And they coined me as a notable bear about 3 years ago. I started calling for $40 crude oils back then, based on the cycles Paul just pointed out, that, we have to get to a low. And for the last 20 years, the low in WTI has been around $40 a barrel. I enjoyed it back in August. I've been reiterating that for literally for years and for months. It's just becoming more legitimate now. I'm looking less of an idiot. But that's the way markets are. You got to get thrown in the mat first. And back then, the same day, my friend in Texas and my friend in Saudi Arabia both called me up and said, "You're an idiot." And it's just one thing I love to hear from people in the space. So I still think I do agree with Paul that we're going to reach a low at some point. I'm still looking for $40 a barrel. But let's talk about the elephant in the room. And one thing you did mention, I thought the steady downtrend, but not that bearish. I look at let's talk about the elephant in the room, and that is that WTI crude oil is down about 16% this year, with beta, the S&P 500, up about the same. The first prerequisite for crude oil to have any type of stabilization of this extreme bear market, we all know every trend is lower prices, is we have to have the stock market stabilize and at least stay going up. If we get a normal 10 to 20% correction, that'll easily, I think, get to my $40 barrel. Not so much target, just pointing out that's what's happened for the last 20 years. Every time you get above 100, people call for the demise of shale, and that elasticity kicks in, and we're in the cycle now. The difference now is crude oil is not alone. It's very much similar cycle as the grains. Corn, soybeans, and wheat are all doing the same thing. It's a normal cycle. The key thing to remember about commodities that are elastic, and crude oil is more elastic than it was any time in the past, is they usually go down and stay down after they pump up too much. And that's the cycle we're in right now. It's a question of where is that low price cure going to come? So I'm still looking for $40 a barrel on crude oil. I think it's going to be happening soon. I think a trigger to make that happen is when at some point we get a little pickup in stock market volatility, which maybe will never happen. But to me, that's the key thing that's buoying everything, including things like copper. So I look at it in that space. And the key thing to remember, I think, about crude oil is, as Paul mentioned, we mentioned things like EVs. My EV is 11 years old. And the thing is, if you look at total miles driven in this country, they're straight up. But unleaded gas demand is flat or stagnant. Same thing with like in China, imports of crude oil from China, despite the fact they've been filling up their reserves. Their demand is the same as 2020, right before COVID. So, and in the meantime, we see supply increasing overall. But to me, it's the macro phase. It's the normal phase in the cycle. You got to get to a low price cure. So far, I'll point out what's happened this year. Like in crude oil this year, the low is basically $55 a barrel in WTI. That's essentially, as Bloomberg New Energy Finance predicts or points out, is basically it's basically the cost of production. So we're bouncing the cost of production. That's what it's supposed to do. But typically you have to get below the cost of production in the world's largest producer and net exporter now. And that's the key thing that's changed. So every single time we bottomed the 40, 3 times in the last 20 years, is the U.S. back then was mostly a net importer, now a net exporter. So I still think that cycle is going to happen. And a key thing that I want to point out too is in the natural gas. We'll talk about this later too. Is natural gas is all part of the same energy phase, and natural gas, I think, is on the cusp of going from 4 back to 2. That's U.S. natural gas, partly because last year we had a colder than normal winter. The market popped up on that. It's priced for another colder than normal winter, and God help us if Mr. Trump is right that global warming is a farce. Is he something like he said, like to the UN? Because if we get 2 colder than normal winters in a row, that's going to throw the whole global warming thing down on the mat. So that's why I'm expecting this year to not be a colder than normal winter. And January gas right now priced about 4. The peak was around 6 to head closer to 3 than towards 5. So to me, that's the overall view. And the bottom line to me for crude oil to stay stable here, to anywhere to end these downward trends, it's all trending lower, is your number one requisite you have to have is that U.S. stock market has to stay resilient.
All right. Excellent introductions from all 3 of our panelists. I want to come back to, let's say, 20 years ago. A lot of people made a pretty good argument that there was not peak oil demand, but peak oil supply risk. The thing was, they didn't anticipate the shale revolution. The thing about shale is that the time frame, the lifetime of a shale well is much shorter than the lifetime of a conventional oil well. There's a very interesting argument that, wait a minute, what if the shale revolution is played out and it's ending, and that means that the supply of shale oil that the U.S. basically came to the rescue with and saved the world from a crisis with is ending, and it's about to be, oh, wait a minute, I've heard this for at least 10 years now, that shale was played out. Is it played out? Is the Western U.S. really drilled up like Swiss cheese to the point that we're not able to make more shale? Or is it just a question of we've picked the low-hanging fruit and there's plenty more shale oil, it's just maybe a little more expensive to produce it? How far into the shale story are we? Is there a date at which it's played out and over with? And what would it mean if that does happen? Let's start again with Arjun.
I mean, while I painted sort of at least an intermediate to longer term, more constructive view, one of the areas where I tend to disagree with, I'll call it the Super Bowls, is the idea that shale is played out. And so our recovery rates today are anywhere from 8, 10, 12%, depending on the area. It does seem like this initial bout of wells that would yield a good corporate return on capital under $70 a barrel, this initial batch of that, more companies are through that than not. So we're in a little bit of a temporary maturing phase, which was sort of my comment that at least for the next 2 to 3 years, I don't think we easily go back to that kind of million barrels a day of supply growth that we were having 10 years ago. But is shale played out in some 100-year context? Absolutely not. If you are a company with shale assets, these are franchise assets. We may not get to North Sea recovery rates of 70% in your best fields, but I would have a lot of confidence that with a price cycle, you'll take those recovery rates from 10% to 15% to 20%. But I actually agree with a lot of what Mike had to say, which is you do have to have the cycles. They motivate supply destruction or demand stimulation or the opposite. If I could just add one add-on to stuff that I agree and disagree with Mike on, is could we get to the 40s? Absolutely. I mean, it's half a standard deviation trading away. And if you have some market volatility and Trump-China trade war noise or what have you, no doubt. What I would say as an equity analyst is when I chart returns on capital for this sector, I think people to some degree are too bearish, not talking about Mike specifically, but the market, that we're going to retest the 2020 and 2016 profitability lows. And to me, we're more likely in that 98 to 08 period where having an 8, 9, 10% corporate level return on capital is a near-term trough. These return on capital cycles are 10 to 15 years up, 10 to 15 years down. We made a 15-year structural bottom in 2020. And I'd say we've now had a pullback in profitability that, again, I'm going to use the phrase in the bottoming phase. I wouldn't disagree that you can touch the 40s on a trading basis. What I'd say is from an equity standpoint, and even from a commodity standpoint, we've had the bulk of the downturn. But to answer your question, shale's got a long way to go, but it's going to take price cycles would be my short answer.
Paul Sankey, is there a risk of shale playing out, or is that just fiction?
Well, actually, I've got a little bit of a point of order, Eric, which is that the lifetime of an unconventional well is actually longer than a conventional. They have a much higher initial decline rate, but then you have an enormous, long tail that could easily outlive a more conventional, let's say, offshore platform that would have to be decommissioned, and so it would actually have a relatively shorter life. But I don't want to be, excessively pedantic. It's not that relevant. The fact of the matter is that there used to be an old line, and this is 10 years ago, that there's been 1 million wells drilled in Texas and 1,000 wells drilled in Iraq. So what you've seen here, of course, there's ostensibly much more oil reserves in Iraq than there is in the US. So what you've seen here, obviously, is a much higher level of activity, enormously higher level of activity in the US. And it's quite interesting why it's actually a legal reason, which is to say that in the US, activity is land and most activity is private. And you can separate mineral rights from land rights. And that means that you can incentivize drilling much higher levels for much more long term than, for example, let's say the Paris Basin underneath Paris, which is easily one of the most geologically attractive unconventional basins in the world. But because of the French government against French farmers, you're never going to drill a well there. And that's because the French farmer would take the environmental risk of the activity, but the French government would take the profit. In the US, what you have is the ability for the private individual to take the risk and the benefit of drilling on their land. So you'll always see a higher level of activity here. And you can potentially, as Arjun, this is the most important point, which he's already made, go after another level of recovery, which, keeping in mind that we've only hit, let's say at most 12% recovery out of the 100% oil in place, you have the potential here for a whole nother level of technology potentially. And that was really one of the most difficult things about trying to call the cycle in the past, was that if you were looking at oil in the last peak oil supply argument era of 2000 to 2010, there was an absolute conviction that we were simply running out of oil in places like Saudi Arabia without any attention to what the price effect would be on supply, or rather what the price effect, I'm saying it right, the price effect would be on supply, because you would simply add a whole nother level of supply. So let's say we went to $150 a barrel sustained oil. That would open up an exponential extra leg. That's the wrong way of saying it. That would open up a massive incremental leg of US supply at a higher price that would then bring the level down. So I would say to you, at $60 a barrel, are we running out in the US? I would say yes. I would say I think that we've drilled so aggressively, it's been so well developed, that we are reaching a point that, you know, we don't have a whole lot more that's highly returns generating at 60, which would obviously be an argument that you can't go a whole lot lower than 60. So to that extent, yes. The other aspect is thinking about AI and technology. Clearly, we're opening up more supply than we had previously, simply by virtue of better technology. For example, applying what we used to call big data, which is now known as AI, to mapping geology and everything else. So I think it's very difficult. There is, exactly as Arjun said, there is really no known limit at the moment on how much there is a sort of a hard stop. You have to give me a price, and then I can begin to start saying there isn't. And I'd just like to add that I'd been a bit like Mike before summer. I don't fight oil prices in summer. That's the peak demand time. But before summer, I was saying that I felt that the next leg would be to go to 40. And it was bugging me quite badly, actually, because not that I didn't think that the balance was terrible because it looked terrible, but because of inflation. And so what we're talking about here is US dollars that, obviously are being devalued. Look at gold by example, and the ratio of oil to gold is telling you that. And so that 40 becomes in 2016 a 30 call or lower. And that was what was worrying me about calling for 40. It wasn't the fact that the balances looked terrible. It was the fact that the dollar is being devalued. And I think, the way this podcast is titled, which was oil's the worst performing asset of the year to date, was a very interesting aspect to that. And, the way I look at it would be, for example, why were the Chinese building so much oil inventory, 1 million barrels a day at times this year, and buying gold, but US investors were buying gold and not oil? And so I think the extreme bear arguments will struggle with inflation. And I'll leave it there. Thanks.
Mike McGlone, do you agree with my premise that it is the U.S. shale boom that's kind of what saved the world for the last 20 years from declining production elsewhere? And is the shale boom at risk at all of having an end date?
Well, that's the problem. I think I was hoping we get some good disagreement and discord. I basically agree with almost everything that Paul and you and Arjun just said. The key thing is I agree with the bottoming phase thing. And that's the key thing that happens in bottoming phases. First, you were typically early. And if you're a trader, you might pick at longs, but you're being very nimble and careful with tight stops. And that's the key thing, is the whole setup for this bottoming phase started with the peaking phase, which peaked with Russia's invasion of Ukraine. That shifted the world order to, let's find better ways to handle this fossil fuel, shift over to EVs. And just what Paul mentioned, it accelerated the technology. I come originally I'm in Miami now, from the Corn Belt. We get a lot of our energy in this country now from ethanol. And I have to mention soybeans because we're getting more and more from soybeans. It's just the technology kicking in. But the thing I've loved about shale is the elasticities. And I've enjoyed looking at this. The most significant trend in commodities for the last 20 years has been the excess of U.S. supply of crude oil and liquid fuels over demand. Now, that's the data from the Department of Energy, some other, and that's continuing. The only time that really has been altered is when the price dropped. You can see it curtailed, that supply came down, and it kicked it higher when price went up. It's been very elastic, and the difference has been basically about 12 months. And that's what I think is part of what's happening and been happening a lot with this persistent backwardation is producers are smart enough to know, hey, I can lock in $70, I'm selling forward. $60, just like Paul said, yeah, not so exciting. But the bottom line is it's the technology is overwhelming. We're hitting a paradigm shift in technology happening so fast. So I'll mention two books. The one book I really enjoyed reading, I think it was 2017, was The Domino Effect by Erik, pointing out what's happening in shale. And just what Paul pointed out is, yeah, sure, you have quick drawdowns, but these things can last forever. And it's just the ability to bring on more crude is amazing at lower cost. So also at the same time, I read the book, The Price of Tomorrow by Jeff Booth, pointing out how rapidly technology is coming on. Just something that Kathy Woods pointed out, the deflationary forces of technology. Just the fact that my EV, my plug-in EV is 11 years old. I can get that same car in China if it wasn't for tariffs at half the cost, and it's 3 times the efficiency. And that's from 11 years ago. It's just how things are happening so fast, and fossil fuels are being replaced by technology. But to me, that's part of what shale is. Shale was the technology that I remember Reagan mentioning in the 80s. And the bottom line is, what's the next technology? Number one is we started reducing U.S. demand for crude oil peaked in 2005. In China, it peaked in like 1990. In Japan. In China, so far, it's peaked about 2020. You see the trend there? And that's well before EVs. That's just efficiency. So it's both sides of the scale. And that's where crude oil is in the middle of it to have a normal, lower price cure. I mean, you just got to feel pain. I'm from the Corn Belt originally. I still have a lot of friends and family there, and they're starting to feel the pain of lower prices, but they haven't reduced supply, partly because supply is so massive out of Brazil. And that's what's happening with crude oil. You can just get energy now versus anywhere. Everybody's adopting these technologies. In this country, we're going to be bringing in more biofuels from soybeans because we've already kind of tapped out corn. And of course, we're reducing demand, at least for a short term in the meantime, because EVs are just cheaper now. So to me, that macro is quite bearish for prices. And then I have to look for shocks. What's going to change that? I can't predict things like Russia's invasion of Ukraine. Now, some of us got ahead of that a month or two before it happened. I know, Eric, I think you're on top of that, which helped. But that was just short-term trade to put in the peak. Right now, typically, the rule, the thing we know in commodities, it typically takes an elongated period of pain. And when you get short covering pops, they're usually for sale. So I'm looking at $72 a barrel WTI. If we can get a nice little, for any kind of reason in the Middle East, little pop to cleanse out the shorts, I expect responsive shorts will be there. There'll be responsive selling from the producers, and that'll bring on more supply. The questions how it happens and why it happens. And that's why I think we're going to have to take an elongated period down or below, certainly below 55, around 40 before it's all over. And that's also all assumes the stock market's going up. And I have to mention that because we're at the most expensive market in 100 years. So one thing I love to mention is that crude oil to gold ratio, it's the highest ever if on a year-end basis. Things that, only time we've ever been above 39, right now we're about 70 barrels of WTI per 1 ounce of gold. The only time we ended the year above 39, well, the highest ever was 1933 and 2020. That just shows how significant things are this year. So the symbols I'm getting from overall commodities, most notably with crude oil going down about 15% this year, and gold being up about 50%, that disparity, 65%, gold's the ancient store value is the most ever on a year-end basis. The most recent example was 60% in 2008. So I'm worried about, and also I'll end with one other thing that I really appreciate what you said, Paul. It just adds to my bearish divergent weakness you're seeing in crude oil this year. The dollar's weaker. The stock market's just on a tear. Yet crude oil's still down 15%. Those are, in that environment, crude oil should be up. And that's my point, is if we just get a little bit of, say, a 10% correction in stocks, which used to happen, that's 20% crude oil. Maybe that gets us to around 40, but then that's what happens next. So I'll end with this. And one other thing, I was presenting to a bunch of students at University of Miami about a month ago. And afterwards, they're doing a trading challenge with Bloomberg. And afterwards, one asked me about, so if you're bearish crude oil, I should short it. And I said, yeah, well, if I shorted it here, I guarantee it would stop me out go up and then go down. You have to wait for opportunities if you want to short it, or it depends on how you adjust your portfolio if you're a trader. And that's what I think most traders are waiting for, just waiting for a rally to sell, because they all know you sell in the hole, you get stopped, and then it goes down. That's usually what happens to ex-traders like me.
All right, thank you. Mike mentioned in passing geopolitics, and I want to go a little deeper on that and get everybody's perspective. The U.S. is the biggest oil producer, but also an even larger oil consumer. China is a huge consumer of oil. Russia is a huge producer of oil. Exactly what President Trump is set to do next with respect to the U.S. relationship with China and Russia is not completely clear. And I would say, regardless of whether you love or hate President Trump, his style is very much not to show all of his cards, not to tell the American people exactly what to expect until the deal is done. So what are the risks here, upside and downside, as to what could happen as the U.S. relationship with China and Russia develops in one direction or the other? And I don't know if a major peace settlement is on the horizon, near horizon, or if we're about to go to war. I can't tell. Kind of hard to decide what oil prices are going to do if you're not sure which of those things comes next. What do you think, Arjun?
Listen, it's a good question that I'm going to struggle to give a clear answer on. I guess what I'd say, though, is I think it can be overestimated the role that U.S. presidents have on these fundamental supply-demand balances. I think every president wants lower prices. Biden wanted it, and every person before him wanted it as well. They sometimes get it because the cycle goes in that direction. They sometimes don't. When Russia first went into Ukraine, there was lots of calls that its oil supply was going to collapse. It's held in much better than expected. There's been all these sanctions. They've found a way to get the oil to market. I think there's a legitimate debate now after 4 years of war and turmoil. What is the health of the Russian oil industry to, at least in the near term, meaning the next couple of years, maintain their level of production? It feels like we're starting to see some slippage in that. So trying to guess what President Trump is going to do on this is probably a fool's errand. Can there be some negative trade situation that causes that correction that Mike's been alluding to happen? Of course there can be. I'm going to say that these cycles in oil are long-term, 10 to 15 years up in the 2000s. We had 10 years down going into 2020. We're somewhere in the midst of what I think is this new 10 to 15 years, generally structurally better period, certainly for profitability for the oil and gas sector. And I honestly don't spend as much time trying to guess the geopolitics of all this. It happens. Supply and demand are both driven by longer term factors than what presidents think they can do in the short term. Maybe Paul
Sankey?
Your answer. So
yeah, I'm delighted to say that we can. Finally, Arjun and I can disagree. No, I mean, I think it's very clear that and it's repeatedly stated by Donald Trump that he wants lower oil prices. And as I said at the beginning, you have to apply Occam's razor with this stuff. There's so many moving parts; it's so complicated. But when you look at it, he wants lower oil prices. And I think one important aspect of this was a good pick for Energy Secretary Chris Wright, because the biggest issue with oil is the conspiracy of ignorance, right? So basically, what you get is the concept amongst U.S. consumers that oil is some sort of cartel of Exxon combined with Maduro and Vladimir Putin, who are gouging pump prices. This would be sort of Senator Warren's kind of level of discourse on the subject of oil, and of course, it's just total garbage. The reality is that Exxon's literally entirely staffed by engineers who are doing an unbelievable job. In fact, the entire oil industry, if you look at Arjun's company, the ConocoPhillips, every single one of the major oil companies in the US basically has a CEO that's an engineer. It's as simple as that. And so we were delighted when finally an MIT graduate became energy secretary. But what's been interesting is that he hasn't really supported the oil industry. And it's been very disappointing, actually, for many oil CEOs and obviously companies as well, as you see them making these rounds of layoffs, that this sort of myth of drill, baby, drill, which obviously doesn't understand the oil cycle in terms of the fact that if you want lower oil prices, you can't have drill, baby, drill. Companies don't just, they used to in the past, it has to be said, they don't just drill themselves into oblivion. If you push the oil price down, it's going to be don't drill, baby, don't drill. And so the fact that President Trump's overwhelming agenda here seems to be lower oil prices, I think is the simplest answer. One of the most fascinating things that we've witnessed this year undoubtedly has been the importance of Melania. That one was definitely left of field. And so it very much seems that Melania, and there may be a lot more to this than meets the eye. I won't go into that side of it, but basically Melania is Slovenian and pretty obviously in my mind opposes Putin. And the other aspect here is Donald Trump clearly has a lot of humanity. He really hates the killing. I genuinely believe that. And so that's why, I think a part of it is braggaggio, obviously, but at the same time, I genuinely think he wants to stop killing globally. And Vladimir Putin, in my mind, is a psychopath. And so what you've got here is a situation where initially, obviously, Trump was bizarrely, in my mind, supportive of Putin and anti-Zelensky. We all watched this. Over time, Melania has got to him. This is, maybe I'm making all this stuff up, but it's what I observe in my mind. And actually has quite 100%, 180-degree turned Donald Trump's view of Putin, which has manifested itself in the past week or so with much tighter sanctions. The problem with the sanctions, which popped oil $5, is they popped oil $5, and there's a million ways to get around.
Okay, let's continue on. We'll come back and get the rest of Paul's answer in just a minute. Mike McGlone, let's pick up where Paul left off, if you will, with respect to geopolitics.
Well, that's the key thing I love about the lesson I've learned in Bloomberg media. A lot of people might not love about Donald Trump, but he's a gift that keeps on giving every day. He gives us something to write about and speak and volatility. And yeah, might love him or hate him, but his focus on getting a Nobel Peace Prize, I'm like, yes, at least we got that going, because there's anything that, the guy is pretty, having grown up in New York, it just, the thing calling him Taco is just, that's not Donald Trump. The guy's a badass. And if he wants lower prices, he'll figure it out. Just go with it. And people still underestimating this man is the thing I learned about when reading the book At War for Ourselves by General McMaster, and also the other book, No Trade is Free by Robert Lighthizer, is exactly what those books predicted has happened. You got a bunch of loyalists, and he's hammering hard on tariffs. The whole rest of the world is facing an unprecedented paradigm shift in the world's largest demand pull economy in the world, just shutting it off, saying, sorry, but we're done with that. And that kind of environment is kind of shocking to me that copper's going up, but it has a supply constraint. But it makes a lot of sense. We're seeing that divergent weakness in crude oil. And it's a question of when we get this more severe deflationary forces out of China, what stops it? But the key thing is, if this person says he wants lower crude oil prices and he has the ability to do it in an environment that, I need to point out one key fact and a statistic that I've enjoyed using for quite a while from the Department of Energy. We have this, it's U.S. crude oil liquid fuel net imports, because when they started this database 25 years ago, it never thought the U.S. would be a net exporter. It's running negative 4 million barrels a day. When the last time we dropped below $40 in barrel, it was about flat. The time before that, in 2016, it was running, we were net importing around 5 million barrels a day. Now this is crude oil liquid fuels, so it's everything. But it's just, the problem is now the U.S. has a glut of crude oil and liquid fuels. We have to export this. And if we don't, prices will go down. That's what's happening with soybeans and corn and wheat. And so to me, it's not a different bucket. But the key thing is, from a geopolitical standpoint, is I'm fully expect he's going to be right. Cycles are working in his favor. And I did love talking to our DC bureau about my prediction that right now, unleaded gasoline's running $3 a gallon in this country on average. I said it's going to $2. What's so weird about that? It's dropped around $2 for 2 or 3 times the last 20 years. All it takes is just a little bit of drop in the stock market, crude oil dropping to near 50, and it's just hovering on that support around 50. Same thing in natural gas. It's bottomed there too for decades. And we just get a little bit of normal global trends. By this time next year, I think Mr. Trump's going to say, hey, it's midterms, and guess what? Energy prices are real low. And he's going to take all the credit, but the trends are going in their favor. So I'll end with one thing. There was the other day I was asked on live TV to comment on the potentially refilling the strategic petroleum reserve. When Biden started releasing, I said, this is going to be the best trade in history. Because not only that, he started releasing the average release, was it about 500,000 barrels at $100 a barrel, and you could have bought them back in backwardation and instantly locked in $5 billion. Now, still in backwardation, you can lock in handles in 60 handles versus back then. So I mean, their combined trade between Biden selling and Trump buying has been one of the best trades in history. And here's a key thing I'll point out: what's changed is the SPR was started in 1974 by President Ford to cover 90 days of imports. Like I just pointed out, we're exporting net exports liquid fuels about 4 million barrels a day now. We're exporting, so we got a problem, and that's just, it's a good thing. Particularly as Russian oil is being sanctioned, but this is the overall trend, and it just fits into me a normal bear cycle. Sure, it might be bodying me, but I think unfortunately we're going to see a lot more price pain first.
Thanks, Mike. Paul, we lost you in the middle of your thing. Do you want to add anything further on geopolitics?
No, I think that my feed will keep getting cut because it wasn't the internet that cut me. No, I think that the general idea was that it's going to be very difficult to second guess the geopolitical situation. I think the rare earths thing is absolutely real and very difficult to get around. And I also think the Chinese know that if they bring the stock market down, they can potentially put a lot of pressure on Trump. So there's a couple of very interesting dynamics within that. The hardest one, I think, is the endgame in Russia. I think it's just very, very difficult to know whether, if you look at the situation in Venezuela, which is another very interesting situation, whether or not Russia is going down the route of Venezuela, which is, obviously ultimately going to be bullish for oil in the way that Venezuela, Chavez through Maduro, has been unbelievably bullish, not only for US oil producers, but also US refiners. So, the potential is there for a long-term situation, unfortunately, especially as I mentioned, that it seems that Trump has sort of, if almost drifted away from trying to solve the very intractable problem of Russia, Ukraine. And so I worry that situation could continue. By the way, I was told, by a source in the State Department that part of the agenda that you're watching in Venezuela is to get Maduro out and to open up the oil now that it's effectively been destroyed by, whatever that is now, 25 years of rank socialism, starting with Hugo Chavez in around 1998. They've destroyed one of the great oil industries. The best state-owned oil company in the world, PDVSA, as was when Chavez took over, has become a total environmental disaster, and it's an absolute tragedy. But watch the Venezuela situation as potentially one for generating more oil supply. We don't really know, though, and as we all agree, we don't really know what's going on in all these situations. Thanks.
Peter Lynch used to emphasize, pay attention to the things you see with your own two eyes, not just the data that we follow in markets. Something I can't help but noticing, guys, is, 10 years ago, if you drove an SUV, you probably don't admit to that when you go to a cocktail party. If you've got a plug-in hybrid, you're waving a banner to kind of show off your status. Now, all of a sudden, it seems like the marketing has changed. Every major SUV manufacturer has like a 600 or 700 horsepower version of their car, and a lot of performance cars, muscle cars seem to be back. And I don't know what the technology is enabling it, but really muscle cars, like 700 horsepower muscle cars. That seems to me to indicate, and I'd say it's happening at a time, IEA, I felt, really was politicized in terms of the way they've reported some of their data. It feels like we're feeling a backlash where everybody's saying, okay, look, enough of this climate environmental sensitivity stuff. I want my muscle car. I want my big SUV again. Is that a signal we should be paying attention to? Arjun?
I mean, it was probably the reason I retired from Goldman in 2014. I was happily doing board and advisory work for 8 years. That sort of whole energy transition narrative is the number one reason I kind of quote unretired and started writing on Substack and all this kind of stuff. There was no part of that mindset that we were going to invert our hierarchy of needs and emphasize controlling carbon emissions as a defining societal objective. we can have a legitimate debate whether we should and to what degree care about that or not care about it. But the idea that any person or any country or any group of people are going to say, I'm going to do whatever it takes to limit carbon emissions, above anything else never made sense. And so it is about, when I turn the switch on, when I want to move forward, do I have energy today? And to me, that is a choice every country and every person makes, with the possible exception of some monks and other religious figures. I don't see anyone else anywhere choosing anything other than, can I have energy today? And hopefully it's affordable. We know when Germany got cut off from Russian gas, they didn't say, yay, we're closer to meeting our climate objectives. No, they started burning lignite coal, right? And so, never mind everyone in the rest of the world and so forth. So I will say on the cocktail market thing, I split time between the Northeast, New York, New Jersey, and Texas. And I think, I drive a Tesla in New Jersey and I love it. I like the one pedal driving. I don't drive it because of carbon reasons or anything. I actually like the car. But I'd be embarrassed to say that in Texas. And I think that's always been true. I think that these things are just normalizing everywhere. And I will say this, that when you look at Paul and I have both been refining analysts through our career. For my whole career, people are talking about gasoline demand in the U.S. is going to roll over due to fuel economy standards. And you look back at it, the only time we had an appreciable gain was coming out of the 1970s Arab oil embargo years and the advent of small Japanese cars, which lasted for about a decade, and then it was over. For the last 25 years, we've promised 3 to 4% CAFE. We've achieved 0.2 to 0.3%. So in a 2% US GDP environment, that'll get you to a flattish gasoline demand, but it certainly didn't get you to the declining demand. That sort of efficiency gain, fuel economy piece for climate or whatever reason was always one of the worst assumptions in everyone's peak oil demand numbers, whether it was the major oil companies who had as similarly a ridiculous long-term oil demand forecast as has had the IEA, and they're all in the process of pushing them to the right. I would encourage people to be most weary when people say it's a delayed transition. That is absolute nonsense. We may well discover future technologies that puts at risk oil demand. I do not dispute that. I will dispute that we know what they are today, that which can ramp up and truly displace oil in the context of, again, 1/8 of the world being rich and the other 7/8 in various stages under many different timelines moving up there. So I do think the Bill Gates memo was a real awakening. It's the end of climate catastrophism as sort of a mainstream thing. I'm sure activists and some politicians will still use the language, but the idea of it being like a mainstream thing, I think 2020 to 2023 is going to be the aberration. I say all that, I don't dismiss the need to take the environment seriously. Clean air, clean water, 100% positively correlated with being richer. And I will acknowledge that carbon emissions and biodiversity inversely correlated with energy usage. But the idea that anyone's going to organize society around CO2 emissions control, there is zero chance that ever had any chance to succeed. And there's no chance it's going to have a chance to succeed going forward. What I think will cause the world to eventually decarbonize is when you look at how much implied oil demand there would be in places like India and China, if they were to only use oil, that will be the motivation, as we're already seeing in China, to move to EVs, to move to LNG trucks, to move to LNG ships. But all those kind of things take time. And in the meantime, I'll stick with, I don't know what decade, let alone year, anyone can know today when oil demand is going to peak.
Paul, what's your take on consumer sentiment? Is climate sensationalism winding down?
Yeah, I think it really is. I mean, we called peak ESG, sometime it was fairly obvious on the charts of some of the crazier, sort of inverted commas ESG stocks in around 2021, 2022, where, a lot of it was driven, as we've referenced earlier, and definitely as Arjun was referencing just now, basically a level of ignorance about the reality of energy density, and interruptibility of supply of things like wind and solar. In 2018, I wrote a note called The Greta Effect, talking about, obviously, Greta and her impact and the environmental reporting of the oils, analyzing their emissions work, which actually is better than almost any other companies and sectors, obviously. So my bugbear back then was that everyone was pounding on the oils for their carbon intensity and emissions, and they were actually basically doing a good job of reporting what they were. Led by Hess was actually the first company to have really excellent environmental reporting, and saying, what, do you think Amazon doesn't use any oil? I mean, come on, guys, it's ridiculous. And by the way, we're now in this data center boom. mega boom, whatever you want to call it, in terms of it's difficult to get your head around the scale, which of course is massively energy intense. It so happened that when I wrote the Greta Effect note in 2018 and published it, just so happened to be published the same day as Larry Fink published his famous letter to saying that BlackRock would not invest unless there was demonstrable evidence that a company was some sort of low carbon or reducing carbon, and the two things interceded. I wasn't negative about Greta as such because she had an incredibly beneficial effect. The first thing to say is important to my previous point about the oil industry being run by engineers is that Greta is a high school graduate. That's her highest level of education. So you want to be a little bit careful about what she thinks we should do with the global energy system, obviously. That's clearly the negative aspect of the sensationalism that she was pushing forward. The positive thing, though, that I said about it is that she would serve to make people learn more about how they get their energy and how much they use and how much they need and how dependent they are in terms of this environmentalism as a luxury concept. And that's what I always say, it's a luxury. You have, the classic sort of celebrity on a giant yacht or on a private plane saying, we've really got to save the environment, or people with a lot of time on their hands because they're wealthy suddenly deciding that it's up to them to save the environment with literally no understanding of the global energy system. It was absolutely incredible. And of course, that's also, as I mentioned, now not only rolled over completely, because as people have got educated, they've realized that the oil analysts are not evil conspiracists, the oil companies are not evil conspiracists. We're actually meeting a fundamental need, and particularly a need, of the world's poor to get richer and get out of poverty better through cheap energy. And so you're now seeing a realization, which is really coming as well through AI, as I mentioned, that you're going to need an enormous amount of energy, and you're not going to cut it with a windmill. And simply because it's interruptible, you don't need a PhD in this stuff to work it out. Additionally, I would point out that, for example, solar panels, 90% of the world's polysilicon is made with coal-fired power in China, and more so is more often than not made with slave labor in China. So the idea that a solar panel is hugely superior to a Texas oil well is just completely misguided. And the list goes on. We could start to talk about California policies, which are arguably racist, because the California policies are clearly designed by the rich in California to increase the cost of energy within California. And that, of course, is regressive. It hurts the poor the most. And, as I said, there's no point almost in hammering the point home, but the short answer is yes.
Mike, what's your take?
Well, I so enjoy this topic, partly because well over a decade ago, I did a lot of research on renewables and technology. I installed solar panels on my house in Connecticut, sold it a little while ago. One thing I did is I realized that technology is awesome. No moving parts, just harnesses that sun, helps protect your shingles and roof from all the sun rays, and certainly in the hot summer. By the way, I locked in the cost of that electricity at 2013 price. When it came time to sell that house, and now when you see all the picks up in electricity costs, it looks pretty good. And that's ancient technology compared to what's happening now. So it's one thing that's really happened. Let's remember the key thing that's happened is just the natural progression of technology, which is typically not linear. It's more concave, just goes up higher. This technology is only going to increase. Yes, Trump's pushing back on a little bit, but it's the human condition, improving the human condition is harnessing energy. My prediction in the future is electricity is just going to become easy and cheap. Why build a house it'll be silly to build a house without storage and solar panels, I think, because it's getting so cheap. Right now, we're pushing back on that technology that's readily available from China, partly because they're exporting massive technology, partly because they have to shift over to the technology because they don't have the fossil fuels we have. But just picture this a couple of years from now. And just one thing is also the energy density of batteries is a complete bull market. And what stops that? Your typical EV now is a platform. And that platform has 4 wheels, maybe 4 motors, and it's just about the power source. Now, currently we use a battery. Maybe in some point in the future, we'll use some type of very small fusion device, or maybe some kind of a fuel cell. But those technologies are doing nothing but going up. So my envision of the future is building a structure for humans to do anything and live in without solar panels or without geothermal. I mean, the technology in drilling, stuff I've learned on your show, Erik, is just in a complete bull market. Just at some point, we're getting to plasma drilling, and we'll be able to harness that energy, as Paul mentioned, below the, that's below the readily available in Paris, but you'll be able to dig to it deeper. So I see this as just what's happening in the space. It's part of the reason some technology stocks are so expensive and things, but the space for me is this is just what's happening. It's accelerating in some other parts of the world. Pushing back on fossil fuels, I thought was kind of silly. It's going to happen organically. So maybe Trump's tilting a little bit too far to one way, but that's the key thing to always remember about one of the most significant strengths of this country. It's a self-correcting mechanism. We've got midterms in a year. He probably will lose a majority. And then we got the next election in 2028. And it's going to be another shift, probably back the other way. But imagine what's going to happen with the average cost of renewables by then, particularly stuff coming out of China. It's just, the technology is amazing. And that's part of the reason I remain bearish on the actual energy price, but bullish on the equities if you pick up the right ones.
Gentlemen, we're just pushing an hour that we've been talking about oil, so I want to move on to natural gas. I'm going to start this one by just pointing out 3 bullets that come to my mind about why I think we're at the cusp of an important time in the natural gas market. I don't know if that's up or down on prices immediately, but first of all, the liquefied natural gas logistics capabilities that just didn't exist 10 or 15 years ago. We've got the export terminals being built. We've got the LNG carrier ships. We've got the liquefaction capacity that we can really take that huge arbitrage opportunity that wasn't possible before, where you've got very low U.S. natural gas prices, much higher natural gas prices in the rest of the world. Exporting in order to monetize that arbitrage is becoming possible where it wasn't before. So that's one. The next is, a lot of people have made really good arguments about the growth of the global population and the demand on food supply and what it's going to mean. Natural gas is an absolutely essential ingredient to making fertilizer. You cannot grow the food supply without natural gas. And I think maybe the biggest and most underappreciated one is that a lot of people are really looking at the data center growth, the general increase in AI, the AI revolution, how much electricity it's going to demand. They know the right answer in the long run is nuclear, but they also know that nuclear takes at least 10 years, maybe more like 15, to build out new supply. All of the smartest people I know in that market are saying the same thing, which is the logical way to do this is design your nuclear power plant where you can build it tomorrow as a natural gas plant, and then you will replace the natural gas with nuclear over time, because that's going to take longer. Oklo is actually one of the advanced nuclear startups, is engaged in a whole business strategy around building natural gas-fired generation facilities that will eventually become nuclear. So I think look at what's happened in uranium in the last 6 months. It's because of the AI contagion, I think, and I think people are missing the trade. It's really a natural gas trade first. It becomes a nuclear trade 10 years later. Those are my immediate observations on natural gas. Let's just go high level. Arjun, what do you think of the natural gas market? What's the big picture in your mind? Do those points resonate, or do you see it differently? And is it bearish or bullish? What do you think?
Erik, I wholeheartedly agreed with the views you just articulated, and I will give a shout out to your podcast. You have been early, and I'm going to say correct on the nuclear trade. You have those great year-end episodes where you do a deep dive with a couple of guests, and you've regularly highlighted nuclear. And I think that is really probably what has perhaps changed the most in the last few years, the consensus around just energy nerds talking about nuclear to now it being, dare I say, bipartisan support for building out nuclear, but it does take a decade. So I spent some time pushing back on kind of the peak oil demand argument. It gets less attention, But look at the IEA's forecast for global gas. They have that thing rolling over by the mid 2030s. And while I will accept one can have a discussion about oil, I don't understand how anyone can say that natural gas demand is going to be peaking on a global basis or in the US or anywhere else by 2035. And again, similar to oil, I don't think there's a decade, let alone year, where we know when gas is going to peak. I will say this, though, for gas to grow appreciably, it has to be price competitive. So I'm a demand bull. And by virtue of being a demand bull, I'm going to say that I have to be also maybe not a price bear, but I don't believe in a gas price or LNG price super cycle. We can always have cyclical effects for a year or two. Clearly, cold weather or warm weather will impact prices on a seasonal basis. But I will say for gas to gain the kind of share I think it's going to want to gain, it's going to have to be competitive. If you're talking about demand shifting from Japan, Korea, and Taiwan and LNG, which has been the historic dream buyers, they have no indigenous resources of anything, and they'll pay a world equivalent price for 25 years. If you're going to try and make share in China and India, I think India is going to have a whole lot of solar plus batteries and coal. China obviously has a lot of coal and a lot of solar and wind. And I think for natural gas to have a role in there, it's going to have to be at the lower end of some price that still stimulates LNG expansion. It's a diversifying fuel, as other benefits around food that you articulated, Erik. And I think it's going to grow in absolute terms. But I push back on sort of the gas price bulls. So I'd say from a corporate standpoint, which is kind of what I focus on, what are the low cost gas supplies? You can't be invested in higher cost gas. You can't be making a bullish price bet as a company. But there is opportunities. The cost curve is steep enough that whether it's LNG, whether it's a trading business around LNG, or whether it's Henry Hub gas, being at the low end of the cost curve and then being able to supply gas, I'm going to say at 3 to 350 in the US, maybe we can add 50 cents to that if we want, but we're not adding $3 to that. Maybe $4 is the high end of the range. So I'd say demand bull, but to be a demand bull, you have to be certainly not a price bull. Bear is not quite the right term, but price is going to have to stay competitive for gas to gain the share that I think it can.
Paul, what's the big picture on natural gas?
Yeah, I think the only thing that hasn't been mentioned, which is so obvious, probably you didn't mention it, is just the abundance of natural gas. So basically, if you have oil occurs, I always like to say that oil is actually liquid solar power in energy dense form. That's relatively easy to produce and relatively global abundant. I think that oil's had a major public relations problem as much as anything, and of course there's been some bad actors in terms of bad things that have happened with oil over time, in terms of things like oil spills, obviously, and other environmental damage. But if you think about the sheer quantity, 108 million barrels a day of oil consumed daily, the amount of spill is absolutely infinitesimally small. The big issue, obviously, is the debate on carbon and carbon emissions, and that's where oil loses out, as indeed does natural gas to nuclear. But of course, natural gas still burns cleaner than oil, and in that regard is obviously as well hugely superior to coal. And then, of course, the combined cycle gas turbine, which is really a wonder of engineering in terms of its flexibility, its ability to burn any fuel, but particularly effective with natural gas, very well suited to modern grid needs, means that natural gas is absolutely the way to go. And I can't stand the way the environmentalists, such as they style themselves, I don't believe they're really acting that environmentally at all, tried to rename it fossil gas. And I really don't like the way these are considered to be fossil fuels, and then coal gets lumped in with natural gas, because natural gas is so much cleaner burning and so much a better solution for our energy needs. And then again has the obvious advantage that you mentioned of being much more buildable, let's say, than nuclear. There's a phrase people like, which is well known, which is NIMBY, which is not in my backyard. And that's one of the major issues with the concept of environmentalism as a luxury. And the second deeper version of that, which you see a lot and you see it all the time when you think about it, is banana. which is build absolutely nothing, absolutely nowhere at all. And there's this, vocal minority who purport to be acting in the world's interests with a huge degree of arrogance because they seem to believe that their solution environmentally, which they really can't have just by definition of being a human on Earth, their solution is banana. And I just think they should be opposed. One of the worst we saw under the Biden administration was this opposition to LNG, which is, as Arjun's referencing, being exported to huge coal-consuming countries. And in fact, the reality is the entire lower emission environmental agenda, apart from the fact that 70,000 delegates fly to every year to an environmental conference and basically achieve nothing, is the fact that India and China make the entirety of what's going on, certainly in Europe, in terms of trying to lower emissions, completely irrelevant. And so you have a country like the UK, which already has some of the lowest, if not the lowest, carbon emissions of any major economy in the world, trying to further lower its carbon emissions and recently announcing a huge new solar farm under Ed Miliband, who's had a disastrous strategy as UK energy czar. They're going to build a huge solar farm, which is in the UK, the windiest place in Europe, but also one of the least sunny places in the world. And as I mentioned to you earlier, those solar panels are built in China with coal-fired power by forced labor. So, this sort of stuff just drives me absolutely nuts. And the simple answer, given the difficulty of building nuclear, the proven difficulty of building nuclear, unless you're a totalitarian state like China, is obviously gas-fired combined cycle turbine power with electric vehicles. Where we're going with AI, I don't know, because I think, another concept that has to be raised on any call of this kind is the Jevons paradox, which is to say the more efficient AI becomes, the more you're going to use AI, and by extension, the more energy you're going to have to use. So it's going to become almost like a black hole of energy use until the energy cost gets too high, potentially the environmental cost gets too high, and you have to cease and desist. And that's one of the most interesting things to think about right now is the horrendous energy intensity of AI. I was already considering it because I was pondering the fact that I would walk down the beach and get home and realize I'd taken a 45-minute video on my iPhone of the inside of my pocket, and that would then be a 45-minute HD video, which has obviously gigabytes of data in it. It would then basically be backed up by my subscriptions to Google, Apple, Amazon, etc. Actually, it would be Google, Microsoft, and Apple would all back that video up. And I was already worried about this syndrome prior to this whole AI thing coming through. And by the way, as an independent researcher working on my own, I'm finding that the utility of AI is very questionable because of the hallucination, because of the fact that it presents facts that are fiction. And I don't know where we're going with this, but I'm very concerned about the energy intensity of it. That's for sure. Thanks.
Mike, what's your take on natural gas?
Well, I'll give you my short-term take. I hinted at earlier, so I figures my light just went out that I have as my desk light, but I've used an alternative. First, the short-term is the market is priced for a colder than normal winter in midst of a global warming trend. So if we get a cold normal winter, that's going to be a substantial shift in the pattern of warmer than normal winters. And natural gas, January price around $4 might be justified. Otherwise, what's normal is going back down to $2. And one thing I do want to address when people talk about LNG, let's talk about U.S. natural gas. Total U.S. natural gas, U.S. exports about 20% of it. Now, yeah, that's going up. 10% of that's LNG and 10% pipeline. So maybe LNG goes up to 15%. And particularly the key thing is, remember, the entire state of New York is still not producing natural gas. Just a little wave of the hand from Mr. Trump, who might call some kind of emergency, and that supply is coming on. The key thing I've learned in natural gas in the last decade is every time people talk to me about demand, particularly when I saw all my friends shifting the gas demand, is prices are supposed to go up, and every time that price gets above 4, U.S. supply just kicks in. It's so elastic. The market is so responsive. It's happened again this year. My colleague Vince Piazza, our energy analyst, points out he's bullish natural gas, but he also points out supply, the production is way above most estimates for this year, and we have ample supply. Now, that's obviously U.S. gas. So the short term, I look at gas right now, that Jan contract around 8. I think the risk is it goes lower. Everything's heading lower. So maybe we'll get a bottom around 2, and then maybe we have a case to get back near 4. And you're talking about a trend that's been in place for over a decade. And the only reason it popped up higher because of Russians' invasion of Ukraine. And now we're all adjusting. So I agree with all the macro. The lessons I've learned that the Malthusians got wrong is every time we talk about massive demand in a world of superabundance, when Americans, not just Americans, but humans innovate, and certainly in a supply, a product like this, is you have to be very careful expecting prices to continue to go higher. Now, the producer's another story, but the actual underlying price of gas, I see 4 is expensive where Jan is. I see 2 is relatively cheap, and typically you have to get below 2. And I see a market that's not trading in any big range. And anytime it gets near the highs, supply comes on near the lows. But the macro big picture, I think, is much bigger. And the thing to remember is, every time we talk about AI, energy demand, I get it, but people are forgetting about potentially efficiency.
Yeah.
We'll find some efficient ways for all this demand. And the key thing is also, I mentioned, like the Malthusians have been wrong forever. So I'd be very careful about that. And then, so I think of energy and electricity demand, I think of copper. It's been way outperforming, certainly, and a performance base, way outperforming most other commodities, most notably crude oil, and silver. Silver is the most, the best conductor of electricity. Obviously, that's doing very well. And they're much easier to invest in, much more likely to go up. So I think of investing in things like natural gas. Forget about that actual contract. It's stuck. But some of the equities might do okay. But otherwise, again, that's short term. If we get a normal trend in winter, natural gas not so much this time, by the time we get to March, April, we'll be getting hammered around 2, I think, the front contract.
Okay. Let's move on to what a lot of our trader and investor viewers have been waiting for, which is, where are the trades in these energy markets, both oil and gas? Is it the equities? Is it the commodity itself through either the futures contracts or the commodity ETFs? In which direction do we trade in? Why don't we start with Arjun?
Well, I'll give the annoying disclaimer that we don't make investment recommendations. I will say this, and I'll stick with equities. We're under 3% of the S&P 500. We bottomed at 2 during COVID. I don't believe we're going to have a double dip trough or be a triple dip at this point in profitability, similar to COVID or 2016, and therefore, again, closer to that bottoming phase. Earnings contribution of oil to the S&P 500 is just over 5%, maybe 6%. And when the sector is under earning, as I think it is, relative to the structural trend in profitability, typically the S&P weight would be similar to its earnings weight. So the earnings weight is 5 to 6%. The market cap weight is 3%, and that gap closes. Now, could it close, as Mike has alluded to, because our magnificent 1 of NVIDIA or the magnificent 7 correct down? I mean, it can always be that. So my comments probably are always a little bit relative when I say these kind of things. But I'm going to say that for most of my career, oil has been between 6 and 15% of the S&P 500. I'm going to argue we will get back within that range. I've specifically called for getting back to 10% of the S&P 500. Again, we're at 3% today. I'm not a short-term guy, so no one should be trading on anything I'm saying for sure. That was true at Goldman, and it's true now. But I'm going to say that that's what we're looking out for over the next several years. And I like oil-oriented names. I think I don't get why oil is so out of favor, as if it's going to go away forever. Can there be near-term risks, as Mike especially has alluded to? Absolutely. He makes some very good points in his comments earlier this evening. But I'm going to say oil equities is what I like. I think people are too bearish on U.S. activity. So there's some bearishness around some of the oil service and those types of names. And I guess consistent with not believing in the triple dip, in deep profitability, I'm going to say that CapEx and activity is going to hang in much better than what is discounted out there right now. So I'll stop there. I apologize for the non-investment recommendation, but that's how I'm thinking about things.
Okay. Paul Sankey, do you have a non-investment recommendation followed by and interspersed between disclaimers that you don't give investment advice?
Sure. I mean, I think that just in trading terms, I think I do like the oil short here, definitely. And as I said, our target is February of next year. Natural gas is you're going to be on a weather bet, and I'm actually going with a cold winter. I reckon it might be cold. you get towards the end of October, and you can begin to tell. So there is some tells that it seems it won't be an extremely cold winter, and of course this is all guesstimation. I think it's probably getting better with the use of AI. I was reading actually that AI has done a good job of calling the Indian monsoon this year. So we'll see, but you've got to take a position, and I'd be long natty here. I like that trade. And then the other interesting one, which is very relevant to what we've been saying about the macro, is that, I've said as somebody who formerly worked at the IEA, and by the way, I was at the IEA, my first job of my career in 1990, when Saddam invaded Kuwait. That's how far back it goes. Back then, the IEA had a 5-year term limit on any employee, and that made it a very efficient and relative to government agencies, government agency. And I'm still not quite sure how Fatih Birol, who's the head of the IEA, joined around the time I was leaving the IEA in around 94, 95, and is still there. I can't believe they ever pulled off the term limits, because for many of these people, such as Nancy Pelosi, there should clearly be term limits, and she shouldn't be allowed to trade at stocks either. It's egregious. Anyway, the only good number in oil demand is refining margins, right? The only good number in the oil market is the oil price. The only good number to tell what oil demand is refining margins. Refining margins are doing really well. And some of these, so that's sort of the macro. And then to go back to the stocks, one overriding principle is you don't buy a cheap oil stock, we used to say, but I think it almost applies to any stock, depending on how much intellectual property they have. But in the commodity business, you really don't have a lot of intellectual property to deal with. You don't have an NVIDIA situation, let's say. You're in a commodity business, a cyclical business. You don't buy a cheap oil stock and sell an expensive one. You buy good managements. And so if we look at a Valero, outstandingly managed company, but perhaps, to start at the top, I don't think I've seen ExxonMobil in better shape than it's since the Lee Raymond days, since Arjun and I first met on Wall Street at a ConocoPhillips lunch. He's probably forgotten it, back in around 2002-3. So Exxon is in the best shape I've seen it for a long time. And of course, I always used to say that Exxon's Valero in disguise, which was when I was negative on Exxon, but now their upstream is in such great shape. You have an outstandingly managed company. And of course, what I'm talking about here as well is Arjun's reference to the oil share of the S&P 500. And in fact, the name of this podcast, which is the worst performing asset of the year. Obviously, what we're looking to do is to get in somehow, somewhere over the next however long, and be short AI and long oil, because that's exactly the opposite of what's worked. And eventually it must turn, surely. And so, a company like Exxon is just really good. And I would say the same for Chevron, which has an upcoming analyst meeting. Bearish oil, you struggle with the E&P companies, the exploration and production companies, obviously. So we'll avoid those. But there's great companies there. A FANG, an up and comer like Permian Resources, definitely fit the good management, by good management theme. If you want to get really crazy, you can start trading tankers, for example. I don't really have a strong view on that right now, but there's plenty of interesting stuff to look at in that space. And then if we keep going, turbines are short. I mentioned combined cycle gas turbines. So Baker Hughes is a company that we like, which has got an oil service company, as well as a turbine side to it, an LNG side to it, which is a good place to be. They just had good results. I'm trying to think if there's one other theme here that beyond the AI and turbines, but those are some of the things that come to mind. Oh yeah, I should talk about some pure play gas to power guys. So I think popular ones that are getting very expensive would be things like Vistra, Constellation. Those are still going to keep working as long as the AI theme keeps working. And you don't deploy this much capex and turn it off overnight. And so even with Meta's results tonight, kind of shocking the market a little bit, and with the definite issue of capex getting out of control, in AI. I still think that theme is going to run for a couple of years. And so while the valuation on things like a GEV, that's back to the turbine theme, or one of the independent power producers such as a Vistra or a Constellation, the valuations are, frankly, certainly for GEV, extremely high. 15, 20 times what you'd have to pay for a cheap US exploration and production company, talking about 30 times EV to EBITDA versus 3 here. It's still difficult to fight the AI theme at this point, I think, and some of those names are just some of the basic plays on the theme, which I think can keep working as long as the AI capex keeps coming. Thanks.
Mike McGlone, where are the trades here?
The key thing I like to focus on and point out historically is if you're investing in any type of commodities, it's usually best if you're going to stick underlying commodities, stick with the metals, most notably precious. A basket of precious metals this year, gold, silver, platinum, and palladium, has had basically less volatility than the stock market, and it's up 50%. And historically, over time, it outperforms almost all commodities. And the metals are the only ones I ever like to point out. If you want to invest in that underlying commodity, have that protection. Obviously, gold is the alpha and the beta in that space. But anything else, you're most better off in the equity. So I look in the macro. I just look at the XLE, that Energy Select Spider Fund. It's up almost 90% since the end of 2019, which was a significant period. And USO, actually investing in the underlying crude oil, rolling those futures, is down 30%. Energy index, Bloomberg Energy Index, is up about a third. And of course, gold's up almost 160%. So where does it go from here? The problem I have now is I've been somewhat of a reluctant person on U.S. stock market for quite a while. And I found much better ways to express bullish bullish ideas in things like Bitcoin and cryptos for the last 5 years. But that trade to me somewhat ended and got to near a bull market peak when Bitcoin reached 100,000. We have classic peaking signs there with pile-on trades into poor performance. Risk adjusted, the performance has been horrible in cryptos, certainly even since Bitcoin reached 100,000. And then I tilt over to gold. I've been bullish gold forever, particularly versus the U.S. stock market. And it's now reached such a huge plateau. I think it's very similar as far as being stretched versus almost every mean you can measure from 60 months down to 100 days, that it's very similar to what Bitcoin signaled at 100,000. It's near peak bullishness, and you have to be careful with the pile-on trade. And so I tilt over now to treasuries because I see that U.S. stock market cap right now at 2.3 times GDP. And yeah, it's going to keep going. It's great. But when it does revert, it's going to be serious. And the two key things I looked at as alternatives for the last 5-10 years have now kind of run their course. What's left? And that's why I look at that long bond yield in the U.S. at 4.07%. The long bond is 4.6%. And in China, it's 2%. And it's just the same things I saw that happened in Japan in the early 90s, traded JGBs in 95. And same things happen in China now. Severe deflationary forces. So to me, that's the next big trade is post-inflation deflation. The book, The Price of Time, Edward Chancellor pointed out that's what always happens. And energy is part of that deflation. Gold's part of that. Gold's up a lot in deflationary environments or inflationary environments. Now, deflation in China is, I think, for gold. And key thing holding everything up is that good old U.S. stock market. It's just so dicey and risky here. I think, maybe we can keep volatility low and keep doing it forever. But we all know we've been around long enough that you're supposed to be selling when they're yelling. And I'm very, very much concerned when I see gold going up this much and crude oil going down this much. I'm trying to look back from the future, and that's got to not matter. It's got to mean something. We'll see when it starts mattering.
Finally, gentlemen, I'd like to go very briefly around and just give everyone an opportunity to tell our viewers where they can follow your work and learn more about what you do. Arjun, what business are you in and how do we follow your work?
Verdin, kind of strategy consulting and an investing business. We publish a Close of Business Tuesday podcast that my friend and partner Maynard Holt hosts. I publish my Super Spike to that website. I've also got my own arjun.murti.substack.com. I post all this stuff to Twitter X and LinkedIn, and enjoy it. And thank you for being here and interviewing us, Erik. And thank you to Zero Edge for having me.
Paul.
Yeah, I must say thank you to everyone, and thank you very much to everyone for listening. So my name is Paul Sankey, and my firm It's called Sankey Research, incredibly enough. We spent a lot of time and branding on that one. So as you can probably guess, my website is sankeyresearch.com. And for free, I have a YouTube channel, which is, again, amazingly called sankeyresearch.com. Thanks. No, excuse me, it's the Sankey Research channel. Yeah.
And
Well, Paul, I love your investments into marketing, and it sounds like it's working well for you. First of all, on your program, thank you, Erik, for having me. I'm a big fan. Every Thursday, I click on my macro voices, and I love what I learned from your program. On the Bloomberg terminal, I'm on X. I post daily on X, snippets of what I publish on LinkedIn, and I encourage anybody who wants to reach out. I'll add them to my distribution list until Bloomberg stops me from doing it. They're okay with I do it now. And again, this is the fun part of the job for me. I mean, I spend 90% of my time researching, trying to come up with good thoughts, and be able to play show and tell with good, smart people like you and having a little back and forth banter. I much appreciate you having me on. So thank you.
all right. Well, thank you very much, gentlemen. We really appreciate it. For my part in all of this, I host the Macro Voices podcast, which targets professional finance, family offices, and sophisticated investors. You can find us at macrovoices.com, and it's always for free. For the Zero Hedge debate series, I'm Erik Townshend.